Hello, everybody, and welcome to this week's Nasdaq Dorsey Wright podcast. It is Monday, January 31st, 2022, also known as the last day of a January that has not been fun if you've invested in equities or most risk-on assets. In fact, if you're Nasdaq Composite, this is looking like it's going to be the worst January on record since data starting in 1978. So at the time of this recording here, Nasdaq Composite's down right around 10% so far for the month. If we look at S&P 500, this is looking like it's going to be the third worst January, down about 6%. And that is with data starting in 1988. So pretty significant there. And then the Dow's held up a bit better of the three major indexes this month, down about 4% so far this month. And that's with data starting in 1999. So pretty significant moves for the month of January, David. And we want to start today with some of our major indicator movements that we've seen. And I know you had some thoughts about dollar, or at least some things on the longer term front that you wanted to mention.
Absolutely. And it's interesting because I'm sure a lot of the folks who have listened to the podcast are thinking at the moment, they've already done this. They've talked about these things many times before over the past month. And to be honest, you're correct. But also at the same time, it's one of those things that we continue to talk about, and because it's the relevant things that we have to pay attention to, especially when we've gotten off to the start that we've gotten off with 2022 and January being in such a tough position. And notably, the thing that we've really talked about over the past week has been within domestic equities, seen a lot of changing going on, but on top, really that 10,000 foot top down view, we've actually seen some changes going on with the asset class itself. So domestic equities within Dolly has been losing signals over the past week. And really last week, we saw it move to within one signal of commodities, and commodities has gained pretty significantly. And at the moment, domestic equities sits at 284 buy signals, while commodities sits at 283. So just one signal separating them. And if commodities were able to move into this, the number one position, it'd be the first time since 2016 that we've seen commodities in that number one ranking position. And really at that time, it's kind of interesting because at that time too, in 2016, you saw domestic equity sitting in that number two position as well, while commodities overtook it. And really, what we see as a difference today is there's a little bit more going on under the hood within domestic equities that we would say is the difference between looking back and trying to gain perspective from an environment like 2016. Obviously, rates continue to be a part of the conversation, and that's really what has been driving a lot of the market's movement here recently. And under the hood of domestic equities, as we've noted, we've seen quite a bit of moving around, growth and value. It sounds like we're beating a dead horse again, but it continues to be part of the conversation as we continue to really just see value hold up better. In many cases, over the past 2 weeks, we've talked about value being in positive territory, while a lot of growth things were well in the negative territory. In some ways, we've seen those value plays stay right around positive to even just flat, or even some cases very positive. But generally speaking, growth has just continued to be that area that's been hit very hard. And within Dolly, you've actually seen small cap growth fall down to the 7th position. You've seen large cap growth technically move up to the 4th, while mid cap growth has fallen down to that 5th position. But ultimately, we've watched value groups such as mid-cap value move up into that top spot. We talked about that a couple of weeks ago. We've also seen small cap value move up into that 3rd position, while mid-cap blend sits at 2nd. And if you look back into the history of Dolly, this is the first time we've seen a value group lead since September of 2007. And additionally, it's the first time that 2 of the top 3 groups within the Dolly size and style views, rankings, if you will, are value-related groups. And that similarly is the first time since September of 2007 that we've seen that occur, with small cap value and mid cap value ranking in that 1st and 3rd position. And interestingly enough, if you look back to that 2007 timeframe within Dolly's history on the size and style view, it was these 3 groups: mid cap value, mid cap blend, small cap value, that were in those top 3 positions back in September of 2007. So extremely notable changes in the fact that we're seeing these rankings shake up to the extent and seeing changes that we haven't seen in roughly 15 years in the case of the Dolly size and style rankings. But then when we look at sectors, we're also seeing shakeups there as well. as last week we saw energy move up into that first position, not maybe somewhat surprisingly, because energy, pardon me, energy has done well, especially starting off the year here. But it's one of those things that we've now seen energy move up to that first position. It's been primarily from the laggard oil services space, showing improvement relative to other domestic equity sectors. And that's why we've seen a lot of those signals flow to energy fairly quickly over the past week, is it's been that laggard area of oil services pick up a number of buy signals over the past week. Continue to see financials, technology, consumer cyclical, and industrials rounding out that top five. But in truth, it wouldn't be all that surprising to continue to see the rankings shake up as we see them today. Obviously, consumer cyclicals and technology have been hit the hardest here, as we've seen more of those growth-related areas really move down the sector rankings, and more somewhat what we would qualify as defensive areas like energy, like financials, sit up in the top part of the rankings. So not only are we seeing changes on the asset class level, but we're seeing changes right under the hood on the size and style view. We're seeing changes on the sector view. And really, broadly speaking, a lot of this action has caused changes with just in other asset classes as well, where we're seeing the, energy truly pick up a lot of signals here recently from a sector standpoint. We're seeing decent improvement out of Latin America on the international view because of that correlation to energy. Obviously, within international equities, Russia continues to be a part of the conversation, and that's why we've seen emerging markets Europe move down and continue to lose signals there. So continuing to watch where these signals are moving and flowing to within Dahlia is of utmost importance, because it's letting us know where leadership is moving to, or where we may be seeing these longer term trends take effect. And again, I think it was in the email that you sent out this morning, Will, that was interesting to me. Whenever you're looking at this, it was a week of, well, this is the first time that this happened type of week last week. It really felt like in almost every piece we were writing, such and such or X, Y, and Z has occurred for the first time since this time, for the first time since this time. And in some cases, it would be the first time since last year since something occurred. But as we talked about, a lot of those value growth rankings and within size and styles, there's some changes that are extremely significant, to the extent that it's the first time in over a decade that we've seen these changes occur. And that can't be ignored in many ways. And as we, see a lot of these changes occur on Dolly, that obviously is leading to many, many changes within the indicators. And we actually, Will and I, as before we started this call, started talking about the fact that we've seen the positive trend for the NYSE move into bear confirmed status and move below that 50% level. And really, that's something that whether it's me, whether it's Will, whether it's any analyst you've talked to, any move below that 50% level for many of the indicators, especially the positive trend indicator, is very notable. And really, again, is something that you just can't ignore, and you have to take stock of it and realize, okay, I've got this piece of information. Now here's my action. Here's what I believe I need to go do. So very interesting to see all of this transpiring and transitioning over to indicators as well, right, Will?
Yeah. I mean, this environment, I think, reminds me at least of a quote from Morgan Housel that says things that have never happened before happen all the time. And that really resonates with me right now. As you were saying last week, we're talking about things that haven't happened since X date or X date. Also worth noting that the past couple of years have seemed like a bit of an anomaly themselves. Talking about energy, discretionary energy is up like 18% this year. Discretionary is off to its worst start, at least through XLY, that Spider proxy fund. That's its worst start to a calendar year since its inception in the late 90s. So there's a lot of things that just haven't happened before that are happening all the time right now. And on the indicator front, as we'll always say, they're going to keep you objective, keep you rules based, kind of regardless of what's going on. Specifically, like that positive trend for the New York Stock Exchange, that is a concern. On the technical front, you can try to spin things to be a positive, but something like that going below 50 and still in O's right now, tough to spin that to be a positive, at least for the intermediate term, as we've seen kind of below average returns when less than half of the stocks in the New York Stock Exchange go to point and figure the negative trends. Now, on that growth note, I did want to mention a few indicators that we would say that are approaching heavily washed out territory, which that would also suggest that the potential for a mean reversion higher, at least for the near term, not the start of a new trend, but a mean reversion higher is probably more likely than the fact that we just continue to fall aggressively lower from here. Take, for example, the OTC high-low, that's measuring the percentage of stocks hitting new 52-week highs relative to 52-week lows. That's down below 10% right now. Handful of instances in history where you have seen that, as we said, and 1 week is pretty choppy, but further out from that, it has a pretty strong batting average that you have seen stocks bounce to the upside from there. Even if you look at some of the bullish percent, so the percentage of stocks on point figure buy signals, I'm looking at the bullish percents for the semiconductor sector right now. That's at 8%. So 8% of stocks and semis are on point figure buy signals. You have biomedics, healthcare computers down at 15%. So there's a lot of extremely washed out conditions signifying that those who have wanted to sell, decent likelihood that there's been a lot of selling or most of that selling are already take place. That's not to say they can't stay down here for extended periods, because they can, but the historical likelihood, the historical significance of that, taking the data into account, is that we have typically seen some type of mean reversion from this level. And then just backing out here, apart from those couple indicators, I would say that this is a great market environment to have a healthy dose of perspective, because listen to this. So 2017 S&P was up 22%, 2018 was down 4%, 2019 up 31%, 2020 up 18%, up 2021 up 29%. So I mean, these are monstrous years stacked on top of one another, and we're off 7% this year. So we're giving back a little bit. Definitely some rotation going on, but by and large, this is part of the, like, this is what you do. This is your kind of ticket to ride, if you will. At least that's the way I would think about it going through seasons like this.
Right. Well, and we've talked a little bit. You mentioned the fact that we saw a lot of these growth pieces move into fairly oversold territory. When you said that, I was curious to see, where the Vanguard Growth ETF stood as of today. Interestingly enough, now I'm looking at a 20-minute delay quote. We're up almost 1.7%, and it's reversed back into a column of X's. So VUG has moved back into a column of X's there at 285. So maybe we're seeing that mean reversion bounce. We'll continue to watch through the day, see if that plays out. But it continues to be an environment where change is the norm almost now. In some ways, where we've seen a lot of changes within dollar, we've seen a lot of changes within the indicators. We've seen many things rotating around, and that has, at least for the month of January, been the norm. Now, as we begin on into the month of February, that begs the question: are we going to continue to see it, or are we going to see a resumption of what was? Obviously, no one knows, but it is something that when we're looking at many of the things, as I believe we've probably noted on calls before, Will, that last year we saw this rally out of growth, or rally out of value, pardon me, and really that was notable, but it didn't really cause a lot of the long-term changes that we've begun to see now. And that's really a lot of what we're trying to talk about, rehashing a lot of these indicators, a lot of what's going on within Dali. Again, it may sound like we're in the process of just beating a dead horse, but it's something that in many cases, it's the topic of conversation right now. So we will continue to bring any potential changes that we may see, whether it's on Dali indicators or even from the indexes on their charts, either in this podcast, through the Daily Equity Report, or through other varying content forms of media that we create here. But I believe for this week, we've probably gone through as much as we can go through. So we'll go ahead and wrap up today's podcast. Hope everyone enjoyed it, and we look forward to having you join us again next week. Hope everyone has a nice week.